Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan and would like to thank you all for joining us for today's webinar, Real Estate Investing Reimagined with Matt Sandretto of Prairie Hill Holdings. As a quick note, please be aware that Matt will be answering questions at the end of the presentation. However, feel free to use the chat and Q&A functions on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you, Matt.
All right, thanks, Will. Let me just get set up here and then I will get into this. All right, Will, you able to see the presentation and hear me okay?
Yeah, look and sound great.
Okay, great. Well, good morning, everyone. And it's great to be with you to talk about real estate reimagined. And we'll get into that in a second. But let me say that I love the audience of self-directed IRA investors, because if you're investing in your own IRA, it means you reject the status quo. It means that you think you can do better than the collection of mutual funds that have been teed up for you, and you want to get better performance. And I can relate to that. That's what I do every day, managing this portfolio, thinking about ways to reduce risks, ways to increase returns, etc. So honored to be with this group to talk about real estate. So let's get into the agenda. First, I'll just echo the disclaimer that was made earlier. This is not investment advice. It's not an offer of securities. There might be forward-looking statements. These are not going to be updated at any point in the future. And as always, past performance does not indicate future results. All right. So for today, we'll start with just a brief overview of who I am and what Prairie Hill is all about. Then I'd like to take you through the last 150 years, looking at the real estate asset class in general in relation to all others. There might be some surprises there for you. Then I'd like to talk about net lease in particular, and that's the reimagined part. This is the reason we're here today, is that not everybody's aware of what net lease real estate is, and I think when people think of real estate investing, they don't necessarily think about this asset type. And I hope to open some eyes to it if you're not already familiar with it. We'll take a look at the current portfolio, some of the properties that we currently have in the fund, why we purchased them, what we look for. And I think, looking at practical examples is always a better way to look at criteria than kind of a theoretical discussion of, investment criteria. We'll look at the returns in this asset class, what's possible. We'll look at 2022 for this portfolio. We'll tell you about a new acquisition that we're doing, which is a grocery anchored shopping center in Arizona with a development opportunity on the parcel. And then, as Will mentioned, we'll get into questions and discussion. And if nobody has any questions, that's all right. We got some questions, thought of to get the discussion going as well. So with that, this is who we are, Prairie Hill Holdings. We're a private real estate fund manager in the net lease asset class. So it's retail, it's industrial, it's quick service restaurants. We're located in Lake Forest, Illinois, which is Chicago metropolitan area. There's a picture there. This is Market Square. That's it's one of the first, I think it is the first planned shopping center ever developed in America. So it's kind of fitting that we're located right there. I'm Matt Sandretto, managing director of Prairie Hill. I run the investment fund. Before I really got into real estate, I was a business owner, and I owned manufacturing companies, actually printing and packaging companies. So owned a fair amount of industrial real estate, and it was really through managing those companies and having that real estate that I realized that the real estate was a better investment than than the companies themselves. So I sold those companies and years ago, and really focused 100% on net lease real estate investing. Before getting into business, went to Wharton Business School. Before that, I was a pilot in the Navy, so I served in the military for about a decade before business. Current portfolio is about 35 million in net lease real estate. It's a mix of industrial, multi-tenant shopping centers, quick service restaurants, and grocery. And our next acquisition is in kind of the grocery category. So those are the main asset types for us. All right, if everybody's still listening, let's talk about why real estate. There's so many investments out there today, and I think it's important to always think asset allocation of where do things stack up. So an academic study was published in the Quarterly Journal of Economics back in 2019, and the paper came out really right before COVID. So I think it kind of got eclipsed, got overcome by events. But there was a very important research finding that came out in this paper, which was the academics doing the research. They weren't they weren't real estate investors, so they weren't trying to prove anything. But their question was, what's the rate of return on all the major asset classes over a very long period of time? So they looked at real estate, investment real estate, I should clarify. So meaning you're getting rental cash flow as well as price appreciation. They looked at equities, they looked at fixed income, and the fixed income they looked at was government bonds, so treasury bills and longer term government bonds. So how do you think all these fared over the last 150 years? Let's take a look at the numbers. So on an average annual return basis, real estate came out on top at about 8% returns per year annualized. That's a surprising result. I think that's surprising for everyone that real estate beat out stocks. So stocks were about low 7% annualized. Government bonds obviously much lower with the treasuries, no surprises there. What about volatility though? Because return's not everything. You got to look at the is it a wild ride or is it a smooth ride? Let's look at that. So average annual volatility last 150 years. Equities most volatile, no surprises there. But look at real estate. It came in at the same volatility as government bonds, so about 10%. So main takeaways here is that real estate was the best on a risk-adjusted basis. Not only did it have the most return, it had it didn't have the lowest volatility, but it had very low volatility for the return that it generated. And with this type of information, it really makes you question, like, does it make sense to have a majority portfolio in just equities and fixed income? And our answer, it's no, it doesn't make sense anymore. Okay, so when people think of real estate, I think people tend to think of residential. They tend to think of single family homes, multifamily, but they tend not to think about net lease real estate. So let's examine what this is. Picture's worth 1,000 words. So there's a example of a multi-tenant retail right there. Jimmy John's restaurant, an urgent care clinic next to it. What makes it different? So you've probably heard of the terrible T's of real estate. If you haven't, I'll go through them. So the terrible T's of real estate. These are the reasons people hate real estate. It's tenants, because they can be a major pain. for you. It's property taxes and it's toilets. Toilets, because they break, you have to fix them, and it's expensive, and so forth. Well, in net lease real estate, you remove those things because the tenant is going to be responsible for paying its share of the taxes. The tenant is also going to be responsible for paying its share of the maintenance. And on the tenant side, the tenant is typically a much higher credit quality tenant. You're talking about large corporates, investment grade credit in a lot of cases, where the rental obligation on a monthly basis is a very, very small percentage of that company's or that tenant's monthly revenue in that location. So it's very different from an individual that's renting an apartment. Their monthly income might not cover the rent by a large margin, right? It probably does cover the rent, because most people, tend not to try to, lease houses and so forth that they can't pay for on in any given month. But there isn't that much coverage there. Whereas, the majority of our tenants, and in net lease, you see, I'll give you an example. We have a grocery store in our portfolio where they're doing 20 million in sales per year, and the rent is $270,000. So there's just so much coverage there to pay the rent that it's a very different economic proposition. Mentioned this. All right, credit quality, talked about that. Very different credit risk on the tenant. And then lastly, long-term leases. So typically 5 years lease minimum with renewal options. 10 years is obviously better. Longer term leases are better, but in almost all cases in net lease, you're going to have very, very long-term leases. Okay, so let's look at the current portfolio. You can see some of the properties that we've invested in, and different examples of net lease real estate. This is an industrial portfolio. We're actually closing on this next week, so this is coming into the portfolio very shortly. This is a third-party logistics tenant, which is a segment that we really like because it's a growing segment, growing at about 8% a year, and kind of fits this theme of supply chains coming on shore to be able to, keep manufacturing, keep shipping, despite all the issues that we've seen, with overseas shipping from China and things like that. So return profile that we're targeting here is about a 19% IRR, 9% cash yield, and absolutely a recession-proof type tenant that's going to keep going no matter what kind of market conditions we're faced with. This next property here we purchased in the end of 2021. This is a multi-tenant retail property: Chipotle, Five Guys, T-Mobile, Sports Clips. Sports Clips being the only tenant here that's not investment grade, although they are a sizable company in the Midwest. I want to say they have about 50 locations, and they're barber shop that it's like you watch sports while you're getting your hair cut. So it's a great little concept. Five Guys, sorry, T-Mobile, Chipotle, investment grade type tenants. This one, one of the benefits with multi-tenant obviously is that you don't have the binary vacancy risk. If a tenant doesn't renew, you have other cash flow that keeps going when you're trying to release a unit. This is a very good location. This is in Dubuque, Iowa, which that's a big part of our strategy. Is we look for what we call markets that are sort of flying under the radar, which is cities, regions with strong economies, diversified economies, stable growth or stable demographic profiles, but they might not get all the attention from the institutional investors that some of the gateway cities, the coasts get, southeast, so forth. And in these places, we can get the same credit quality, same quality of building, and get it at a little bit lower price, which generates better yields. This next one, multi-tenant, much larger multi-tenant shopping center. This one is right next to the largest mall in Wisconsin. A tenant merchant lineup that we really liked because of the recession type market that situation that we believed we were going into when we purchased this at the end of 2022. We wanted to, we always like tenants that are going to perform well, no matter the circumstances. And Joann Fabrics is a great example of that. They put up massive numbers during COVID, which is not surprising, right? People are doing more crafts and staying at home and things like that, and they hold up very well in recessions. Dollar Tree is in this location as well, and other merchants here that sometimes benefit from the consumer having a little bit less to spend. Also just nine tenants, so very diversified, resilient income stream coming from this property. Okay, this is a single tenant property, grocery store in this is in Wisconsin as well. Pick and Save is a regional brand, but it's owned by Kroger. And what we loved about this property is, one, the corporate guarantee from Kroger. So a corporate guarantee, that means that a corporate's guaranteeing the lease. So if let's say they decided to shut down this store, the lease is backed up by Kroger, which is the nation's largest grocer. They're listed on the New York Stock Exchange, et cetera. So that corporate guarantee makes this a very low risk stream of income from the lease. The other thing is, grocery is just it's been enduring. It has e-commerce has just not been able to change really what's going on in grocery. I mean, there is online ordering. There's certainly online aspects to it, but there's just no way that the stores themselves are going anywhere, right? That even if you were going to fulfill more online or ship, you're still going to have to ship the groceries out of the stores as a kind of a fulfillment center. So we just see this as a resilient segment that doesn't have some of the risks that are present in other real estate types. The other thing is that we got extra land in this acquisition, so there's a development opportunity on the parcel. And development in vicinity of grocery stores is very valuable because there's a lot of traffic, and there's a lot of different uses that you can have, whether it's restaurants, coffee, other retail. So we're going to look to develop this in the years to come. Some of the things that we look to do to kind of drive value on these properties, I'd like to tell you a little bit about those. So one of the things is EV charging. When we get these high traffic retail centers, some of them are perfect opportunities to put in charging, and the economics of charging it's getting better. There's a lot of different business models out there for either owning the equipment or basically bringing in a company to install the equipment. Excuse me. Our approach is to own the charging equipment. That way the stream of income on the chargers is part of the overall portfolio. And when we sell an asset, then that income stream kind of gets added to the overall net operating income of the property, and drives further value. So it enhances the the tenant's view of the property, and the people visiting the property. It increases convenience and so forth. So it's kind of a win all around for investors, ownership, and the tenants. The other one is rooftop solar, which probably generates more income. It does by far, in relation to EV charging, but more expensive to install. But typically within a couple years, you can kind of get the yield on it, get the return, pay back the cost to install, and then whatever is being generated from it is going to increase the value of the real estate significantly, because it's going to be capitalized at whatever cap rate the property would trade at. So the simple example is, if the solar generates an extra $50,000 in net operating income, you probably increase the property value by about $1 million if it's if it's capitalized at that rate. So it gives you a sense of how valuable it is when it's coupled, when it's combined with a real estate portfolio. All right, so what's possible in these types of assets? These are low risk assets, so you're not going to see monster monster returns. But I think for the amount of risk that's being taken, the returns are extremely attractive, especially as if you consider all the tax advantages of the asset class. So let me move this so I can see it. In 2022, on a total return basis, about 10%. On a cash yield basis. So when we say cash yield, we're talking about, from an investor perspective, if, how much cash did you receive back, as a distribution in relation to how much cash you invested. So a cash yield was about 6.8%. So meaning, hard numbers, if somebody invested $100,000, that means they got $6,800 back in cash that year. We're distributing every quarter, and then there was no tax. There was no tax on those distributions in 2022 because of the depreciation that we're able to recognize in the fund. So basically, very different to say a dividend out of a corporation, like if you own a stock. That dividend is always subject to tax, right? Just by nature of the dividend coming out of the C corp and going to you, that's a taxable event. Whereas in a private fund structure, the taxes are determined by the overall P&L of the fund. So if we're able to recognize non-cash expenses like depreciation and so forth, we can reduce that tax bill, and in a lot of cases down to nothing. We can defer it, to the future. See what's not in those numbers. Okay, so we got some notes in there, which we don't have any of the returns from scale. And what we mean by that is we're purchasing properties one by one, but our goal is to exit the portfolio at scale, either in an IPO, taking the whole portfolio public, or selling it as an entire portfolio to an institutional buyer, like a life insurance company or a private equity fund, or a pension fund is another example. And this might come as a surprise to some of you, but there is a bigger market. There is more of a market for $300 million worth of grocery stores than there is a market for a single grocery store that's, say, 5 to 10 million. So there's increased liquidity at scale, which is going to drive higher returns, because instead of just trying to sell a single industrial property or a single shopping center, we're going to be selling hundreds of millions of it. That's our goal. We also don't have any returns in these numbers, for the value add projects that we're starting, the solar and the EV charging. We don't have the development's not in there. We haven't started in any of the development yet. So I think this is kind of like what I would say is like kind of the lower, this is kind of the base case. Like this is kind of just the properties themselves without some of those other projects. This is kind of what the properties do. And then when you add those other things, that's how the IRRs can get into the, we'd say mid to high teens is kind of, where we expect this to finish out at the end of the investment cycle. So, all right. Our next opportunity is in Arizona. It's a grocery anchored shopping center, and it's a value add project. So this is Tucson, Arizona. It's hard to see in the photo. I wanted to give you the aerial photo so you can see the parcels that can be developed. But right now it is a Sprouts, farmers market, grocery store, and an LA Fitness. Those are the two main tenants. But there's a large, pad right next to the LA Fitness that can be developed. 35,000 square foot building could be put in there. And then there's also a pad right out front, which is really perfect for a quick service restaurant. So we're excited about this one. I mean, this is a growing market, and to be able to develop a grocery anchored shopping center within this Tucson market is an awesome opportunity. So we're going to look to develop those over the years to come. These two stores, LA Fitness and Sprouts, are both performing well in this location. The LA Fitness has got like 18,000 members, which is very healthy for them. Sprouts is doing great sales out of the location per square foot. So no concerns with sort of the anchors that are generating the economics right now. And then the upside is to be able to build in that location. And we don't see any end in sight to the steady growth in Arizona. A lot of fundamental factors driving that, but so we're that's next for us. Let's see. I think we're into the discussion point. So why don't we go into the questions? And if we don't have questions, or we get finished with questions first, we can get into the discussion points that I kind of teed up for us.
Yeah, perfect. If anybody has any questions, like I said earlier, please use the Q&A and/or chat function if it's self-directed related or anything related to the presentation so far. Here you go. Here's one coming in. What's the typical investment cycle?
Great question. So real estate is, it's an illiquid asset class. We look to underwrite our investments on a 5-year time horizon. So we want to be able to increase the net operating income of the property, do all the projects that we hope to do, and complete all that and realize the value in a 5-year period. So that's how we look at it. We currently, are still asking for investors to, think similarly and commit for a 5-year investment period. During the 5 years, you're getting cash flow, you're getting the quarterly distributions, but that you wouldn't get the kind of lump sum return back for up to 5 years. However, as we're an open-ended fund, so for us, as our scale increases, we will be able to offer more liquid options, 2-3 years, things like that. So yeah, I would say plan on a kind of a 5-year horizon, definitely a longer term, like private equity kind of time horizon for this.
Great. Thank you for the answer, and thank you for the question. While people are still thinking of questions, I'll ask one, and then if we don't get any more, we can jump into discussion points, and maybe that'll jog some people's minds to get more questions up.
Sure.
So another question is, we're self-directed custodians here, so again, I'd be remiss not to ask, how's your experience been with self-directed IRAs? What's your approach when dealing with retirement funds?
Yes. So I think this is is a perfect fit for longer term capital, like retirement accounts, especially where if you reinvest the distributions. So some of our investors, they take the distributions every quarter in cash, and I don't know, they go shopping or something with it. But a lot of our investors reinvest as well, and that's where that compounding. I mean, that really increases your returns on this. So I think it's perfect. It's a perfect structure for that, where it's a part of your portfolio where that like the whole goal there is to get great long-term returns, and you don't need the liquidity. There's a lot of academic studies that have been done on liquidity, and I think the just looking at the endowments of the world, the Harvards, the Yales, like the way the way Yale's been able to generate the numbers that they've had over the years is not investing in liquid stuff when you don't need the liquidity, right? Because there actually is a penalty. You get penalized. You lose multiple points of return per year for the benefit of liquidity. And liquidity is great if you need it, right? You don't want to invest grocery money in private equity. But if it is longer term, and you're in super liquid stuff that you can sell on your smartphone, just hit a button and sell it all, like I think that's a missed opportunity.
Right. I tend to agree. I'm not an expert, but yeah, no, I agree. So thank you for that answer. We have another question
Sure.
coming in from Charles. Is there a minimum investment?
So we don't have a hard minimum right now. I will give you a sense of what we've got a range of investors. Some have invested, $1 million. Some have invested 50,000. So I think 25,000 or so it's again, it's not a hard minimum. If somebody's interested in this, we are interested in building more relationships. So we'd love to speak to that person. So I'm going to say no hard minimum. The range that we've seen is about 50,000 to 100. Sorry, about $1 million.
Great. Thank you. And thank you, Charles, for the question. It doesn't look like we have too many questions at the moment. So if you want to dive into the discussion points, well, we could do
Sure.
that.
Okay. Yeah, sounds great. So I think looking at risks that's always important, right? The returns, looking at returns and upside is great, but what are the risks here? Some of the risks are just general real estate risks, but so I think let's just start there. I think the biggest risk is vacancy and tenant default. Basically, not being a tenant, not being able to pay rent, going bankrupt, or just having cash flow challenges themselves. Those are the biggest risks. So that's really our focus in these acquisitions, is we're just trying to think of everything that could go wrong in that tenant's business in a forward-looking way. We do the historical underwriting, that looking at their financials and balance sheets and so forth, but we try to look forward, right? Because Blockbuster Video, if anybody's old enough to remember that, I mean, that's a great example. Like they were one of the most successful tenants out there, right? They had video stores all over the place, and tons of real estate, and then they're gone today. They're not here anymore. So I think we have to think like equity investors of where does this business sit in 5 years time? What are the risks to their business model? What are their technology risks out there? We really try and look at that, because if the tenant is in the location, performing well, successful in that location, these numbers for the for the real estate owner, they work out great. They just there's always tailwinds with inflation from the Fed, asset price inflation, land values just go up and up and up and up. It just all those things work as long as the tenant is in the location and successful. So I think those are the big risks. The vacancy and payment default. Those are the big ones. Risks unique to net lease. The longer your lease is, okay, the longer you're fixing the the economics of it, right? Whereas if you have a lot of turnover in say in a multifamily property, you can be a little bit more, you're a little more flexible, right? You can raise rents as needed, you can decrease rents as needed to boost occupancy. So you're a little bit more nimble. And net lease, you're kind of more locked in. And sometimes tenants, especially the investment grade ones, that they can throw their weight around in lease negotiations, and they can try and get themselves a good deal. So as an owner, you gotta think very long term, and make sure you don't take bad deals that may look okay in year one, but after 5 years time, the rent might be so far below market that you're definitely missing out. The other thing is you got to look at, you got to be very careful about where rent levels are going to be at the expiration of these leases far into the future. That if you're building in rental escalators of increasing rents, that's always a good thing. You want that embedded growth. That's important to us. We look for that. However, you don't want the rents going up so much that at the end of at lease expiration, you have a situation where you're way above market, and you wouldn't be able to, like, let's say that tenant left for some reason, you wouldn't be able to replace those high rents because the market is not at that level. So you don't want escalators to put you in a situation where you've increased risk because you can't replace the income. So market rent levels and keeping track of that's also a huge risk. The other risk I'd say is adaptable use. Looking at what the building could do if whichever tenant's in it at the moment, decides to leave or something else, right? If it's, some examples are like some of the entertainment oriented real estate, like, like an example would be like a Top Golf. Like a Top Golf is a Top Golf, right? you can't turn that into a hotel tomorrow. So stuff like that, I think we look for as much adaptable use as possible, where if it's not one business, we can put a different one in there pretty easily. So that's risks. Any questions on risks? I think risks are always important to understand, when you're underwriting investments.
We do have a question. It's not necessarily risk related that came in
Okay.
before you jump into one of your next points.
Sure.
And then if anybody has questions for risks, please ask them now while we're answering this question. But the question asked is my investment spread across multiple projects or allocated to a specific project?
Yeah, great question. So we have a fund, and it gives the diversification. So you'd invest in the fund, and you'd own the properties in the portfolio in the same percentages that the portfolio holds. We do sometimes have the opportunity for somebody to invest in a single property if desired. I think larger investment amounts tied to a single property, that's possible. Or if somebody had a 1031 exchange where let's say they sold something and they want to put a significant amount of equity to work, and they want to be in a single property. And in fact, for a 1031, we really have to structure it that way. We can do that too. Most of our investors, our largest relationship is with a wealth management firm, and for their clients, the diversification is important, right? That like that single tenant grocery store is a great example. Like that is an awesome property, but much better in a portfolio, obviously, than just as a standalone. Whereas some of the other ones, multi-tenant and so forth. And we recognize some investors want to provide their own diversification, right? That they've got other properties, and they don't want Prairie Hill doing the portfolio construction. They want to do the portfolio construction themselves. So that was a very roundabout answer. I would say the fund is what makes most sense for a smaller investment amounts, but there's situations where it makes more sense for that investor to invest in a single property. So if you're one of those people that wants to be in a single property, just let us know. Like there's a lot of ways we can make that work.
Great. Thank you. And thank you to the attendee who asked that question. It doesn't look like we've gotten any questions in for risk yet. So if you want to move to your next point, feel free.
All right, what else do we have on here? Okay, timing. So this is a great, we probably should have talked about this one at the beginning, but you've seen the news. I think Blackstone, BREIT, that's probably the highest profile real estate fund that last year announced that they're stopping redemptions. They're not going to provide liquidity to any investors according to what their policy was previously, and that storm clouds on the horizon, vacant office buildings. I mean, the doom and gloom in the real estate segment is palpable, and I think it's very real. I'm not gonna tell you that it's not, with one big caveat. The big caveat is that there are segments of real estate that are doing great, and you really got to look at the type of real estate you're investing in. So like mobile home parks, for example, not only are they selling at all-time high prices, they're probably going to continue to sell at all-time high prices because you have a major supply and demand imbalance in housing in America and affordability in America. That's not going away. And then you got institutional interest in the asset type, which is bringing tons of money into it, which is driving up prices. So there's that. Industrial, another great example. Industrial vacancies at the lowest rate it's ever been in the history of the country. There's not enough new construction, and those fundamentals are going to continue to drive pricing. Office buildings, there are some big challenges there, obviously. Definitely, 50% vacancy rate nationally, and this whole just uncertainty on what does the future of work look like. So yes, there's challenges there. That's why you got to look at your investments and what asset types are held by that real estate fund or manager. And what you're going to find is some of them have zero exposure to these things. Like Prairie Hill is an example. Like, we don't invest in office. We don't have some of these legacy asset types that are a problem. Interest rates, right? I think people think, okay, rising interest rates means real estate's worthless. It's not that simple, right? I think if you look at the 150 years, that's the first thing, is like what performed the best in the long run. It was real estate. And if you look at like 2008, how fast did real estate recover? Pretty darn quick. If you ask people, hey, if you get housing in Miami at 2007 prices, like, would you want to buy it? The answer is yes, right? If it's Chicago, any market, even markets that haven't seen great price appreciation, are still far above today where they ever were, in pre 08. So it recovers quick. Now, interest rates in the near term do provide challenges. Selling prices in the near term are always going to be affected by that, because real estate is a debt-driven asset type, because the buyer typically needs to use debt financing. So if the cost of financing increases, it's going to, all else equal, reduce purchase prices. The caveat there too, though, is that in the institutional world, there's a lot of buyers that don't use much leverage, and those are kind of 100% equity type buyers. So it's not a simple one-to-one. So the one point I do want you to remember, though, here on this question of timing, is that owners of real estate right now know that now is not a good time to sell. Okay, they know it's not a good time to sell because there's all these negative headlines. The interest rates have gone up rapidly, although the current level of interest rates is not high by historical standards. I think that's very important to point out. But owners of real estate know that now is not a good time to sell. However, there are sales happening, and there's always going to be sales happening. And the people that are selling right now, whether it's an industrial building, a shopping center, single family home, whatever it is, the people that are selling right now are selling because they have to. There's something going on in their life. It might be generational turnover. It might be something else. They're selling because they have to. And when people are selling because they have to, there's good deals to be had. So that's one of the reasons why we're still buying. We're still doing what we're doing, because we're seeing opportunities from that of, we can drive harder negotiations, we can buy at better prices because of that. So now is I think now is a great time to buy, because anyone's selling, they're not selling because they want to. They're selling because they really need to. They can't wait another year. I mean, if they could even wait another year, probably get better pricing, right? So something to think about on the timing thing.
We do have a question that just came in. How much of Prairie Holdings or Prairie Hills purchases are leveraged?
So we do use leverage in all of our acquisitions as a means to drive return. So that's another reason why we invest via portfolio, so that we've got cash flow coming from a lot of different assets. So if we had to reposition something, if we had to deal with a vacancy, we've got cash flow, global cash flow in the portfolio to pay debt service in the event that we had a vacancy or something like that. So yes, we do use leverage. LTVs for us, typically 50% LTV to up to 70-75% in some cases. Leverage has come down with the perception of risk in the economy right now. Lenders are lower leverage now than they were. So, but I think 50 to 60% LTV is kind of that's kind of a sweet spot on a lot of these.
Gotcha. Great. Thank you. And thanks for the question.
Great question.
Yeah, very good question. Thank you.
Okay. Yeah. So leverage, one thing I will say about that, in kind of the big real estate fund world, there's these names given to fund types, which I've never really liked the naming convention. I think it's sometimes misleading, but one of the asset types is called core, core real estate funds. And one of the hallmarks of core is that they use lower leverage. In fact, it's typically lower than 40% at the most leverage. And a study was done recently on value add funds or opportunistic funds versus core. And the idea was, or the question was, if you took core assets, like very low risk, high quality properties, high quality tenants, investment grade, but what if you put a little bit more leverage on those core properties? How would they compare to value add and opportunistic strategies? And the result is not surprising to us, is you actually do better. You do better in return and on a risk adjusted basis by using a little bit more leverage on the highest quality stuff than you do by buying lower quality stuff and trying to reposition it, or buying vacant shopping centers and trying to lease them up, or all those types of strategies. So I think that was eye-opening for a lot of people of leverage. You have to be prudent. You have to be prudent with it, but it is a tool that as an investor you want to use. You definitely want to use it. Let's see what I think I had another one. Okay. If we don't have any other questions, I'll get into this one. So other ways to invest in this type of real estate. Publicly traded REITs. So these are the real estate investment trusts that are listed on the stock exchange. The big names, Realty Income is a big one, National Retail Properties, WP Carey. These are the big REITs. So how do these things stack up, or how are they different from private funds like a Prairie Hill or another private fund? And a couple big differences. So first is just the tax treatment. So if you own interest in a private fund, you're really owning the property directly. Now, yes, there is an investment manager that's managing the asset and taking care of all that fund administration stuff, but you really are owning the asset, meaning you get the benefit of the depreciation and all those tax advantages. And like we were talking about earlier, the cash flow coming out of the fund is not necessarily subject to tax, just because you're getting a distribution. Whereas a publicly traded REIT is a corporation. It's a C corp. For the CPAs and so forth out there, they know exactly what I'm talking about. The C corp gets the benefit of the depreciation, and then the cash flow that comes out of it is a dividend, and it's subject to tax. So that's something right there. The next thing is that in the public market, in the stock market, there is an insatiable demand for dividend income. And what that does is it tends to drive the prices of these stocks up. And as a result, the yield goes down, right? Because if the stream of income from the properties, that's not changing, right? Let's take a shopping mall, for example. You can buy the shopping mall directly. Let's say you just buy it yourself. The stream of income is the rental cash flow, less expenses, right? Let's say you buy that via the REIT. Well, the REIT now, their shares trade in the public market, so they're subject to supply and demand. So if everybody just bids those shares up because everybody wants that income, well, guess what? The income coming out of the mall, that didn't change, but the price that you had to pay to buy that stream of income was much higher, which means the yields are low. So in the publicly traded REITs, you're getting crappy yields in most cases, really, really bad. When you compare it to the assets that they own in their portfolios, a lot of them own incredible properties. They own great properties that are generating much higher yields than what the REITs are doing. Now, on a long-term basis, you're kind of getting the returns of the stock market for the most part, but you're not avoiding the volatility for sure. You're getting that volatility of sentiment that doesn't exist in the underlying property, because property values just don't change in a minute. You know what I mean? They're much more stable. So we talked about kind of the price that you're buying in at, very high in REITs, and then the taxes. Those are really the big differences there. So publicly traded REITs, not saying they're bad, but they don't really behave the same way that real estate does. So in a sense, I think when you're buying them, you're stock investing. Basically, you're buying the company's shares more so, which some would say you're buying a piece of paper. And the funny part there is they don't even print stock certificates anymore. So I don't even think you're really getting a piece of paper anymore. So you're not really owning the underlying land and buildings and all that. So I think that's nuanced, complex topic, but just some things to think about there.
Great. Thanks, Matt. Any questions for Matt while we still have him and have his time? Please do them now. And it looks like you were just about to jump over to a contact information slide, potentially.
Yeah, if we don't have any more questions, we can wrap things up. And
okay, yeah, I don't see anybody asking questions now, but just if you want to bring it up now and leave it up, so you can potentially close out things if we don't have any more questions coming in. If you want to leave people off with something and how they can go about contacting you, please let us know.
Yeah, so I threw our contact info up on the screen there. Investors at Prairie Hill, my email's up there too. Business partner Elisa, hers is on there too. But yeah, we'd love to hear from everybody on the call. If you have questions or you want to talk more about net lease, we'd love to hear from you. Even if you're not interested in investing, if you got questions about it, we love real estate, and we're always happy to have the conversation. So please don't hesitate to reach out.
Amazing. Thank you, Matt. And on behalf of Camaplan, I'm sure the people attending now and people who will be watching this in the future, the recording, thank you for your time, your insight, look into what you guys are doing over at Prairie Hill. And I highly encourage anybody to reach out to them if you have any questions. And if you have any questions about self-direction, don't hesitate to contact us here at Camaplan. We're always happy to help answer any questions, talk about what you're thinking about doing, and help facilitate your transactions into these alternative investments. So I thank you, man. Thank you, everybody, for joining. I hope everybody has a great rest of their day.
Thanks, Will, and thank you, everybody. Take care.